Staying the course is toughest when the seas are stormy, highlighting the importance of staying invested and not bailing on your plan until you think things are getting better. This week's fastest 4 minutes in finance. Hello again, I'm Scott Inman. Hey, I get it. It has been hard to stay invested in the stock market this year. The S&P 500 index is down almost 25% year to date at the time of this recording. It's one thing to watch your account values come off its highs. It's another thing to see it stay there for months. We all want the market to turn around. But in times like these, the best thing we can do is keep our emotions out of it and rely on facts. We try to give you those in this segment every week so that you can have an objective perspective. I ran across some interesting data this week that reminds us that if we want to be on the top floor, we can't get off the elevator when it goes down, or we won't know when it's about to go back up. Even the best economic minds get that wrong. Take this. In December of 2021, a survey of 14 strategists predicted 2022 year-end S&P 500 targets that would have equated to one-year returns between -3 and positive 17%. A reminder, we're currently down almost 25. So if you want to stay on the sidelines until things feel like they are getting better, it is very difficult to know when that will be. Also, historically, when the market comes back, it comes back in a big way. A chart from A Wealth of Common Sense reminds us that although the average long-term return of the stock market is 8 to 10%, the market rarely returns 8 to 10%. In fact, going to 1977, only 4 times has the calendar year return fit into a range of 6 to 10%. The average return is the result of wild swings of double-digit positive returns, offset by some double-digit negative returns. It's easy to forget that the 3 years leading up to 2022, the S&P 500 was up 31%, 18%, and 29% respectively. The takeaway here is if you want to assume your long-term investment plan will get average market returns, you have to remain invested. You won't get average returns every year. We can even take a much more microscopic view of that. It's often not about missing the best years that will wreck your long-term returns. It can be about missing the best days. To illustrate this, take 2022. In this example, it's about missing the worst days. According to DataTrek, 9 single days have made up the entire decline of the S&P 500 this year. They say if you take out those 9 days, the index is up 8.6% this year. Of course, how could you, as an investor, know which 9 days that will be? So could you really avoid them? The reverse is true too. If you miss the best days because you guessed wrong, it could be even more detrimental. Bottom line, as difficult as it is to stick it out, historically, it's the only way to get to where you want to be. Thanks for listening.